Welcome back to session number 2 of this course, Corporate Financial Performance Analysis and Evaluation. Today, our focus is establishing, analyzing, and evaluating the financial performance of the company in terms of profitability. To be able to do that, we have to think of the business as an economic unit that takes in investors' capital, uses the money to invest in assets, produces products and services, and then generates sales and profit. We will use that system of input-output analysis to evaluate the profitability of the company. To illustrate the process, the company takes in capital. Capital in the form of money. That capital may be in the form of debt, borrowed money from the lenders, or in the form of equity, money invested by the owners. This is the total input. Company uses that money in assets. This is the company that we're going to use, PCP. It's a real company in the energy sector in Thailand. The company management team used the money to invest in assets. They operate the assets, produce products, and sell to generate sales revenue as an intermediate output, and after deducting the expenses, the company ends up in profit. So this is the input. We will take the sales revenue as an intermediate output, and profit is the final output. We shall use an input-output analysis in determining profitability. We begin with comparing or relating sales revenue to profitability. That concept is called margin analysis. In comparing the final profit output to the capital input. Input is the capital, output is the profit over a period of time. This time will be one fiscal year or accounting year, 2023 and 2022. When you relate the profit to capital, it's called return analysis. Return analysis. These are the two important models that we will use in evaluating the profitability of the business. Margin analysis, which is the profit relative to the sales amount. From there, we shall learn management ability to control expenses. And then we compare the profit to the capital input to see how much profit the company has produced from the investor's capital. That will be the actual rate of return. And to determine whether it's high or low, we are going to compare that with what the investors expected, which is called required rate of return or weighted average cost of capital.